how to free yourself from what I call the IRA 401k tax trap before retiring. So get ready. In this episode, I'm going to talk about what you do at retirement for your planning is something totally different than what you did for your retirement. If you're like 91% of Americans who have too much money and yet to be taxed IRAs or 401ks at retirement, don't get in that trap. Free yourself before it's too late. This episode will show you how. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for more than 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. Now, I have found that most Americans will outlive their money because they've been following the herd, putting money in traditional IRAs or 401ks in the market. And so there's 3 big dangers that most retirees face that cause them to outlive their money, usually within 11 years of retiring. Okay, what are they? Number 1 is taxes. Number 2 is inflation. Number 3 is market volatility. Okay, and money in traditional IRAs or 401ks in the market are subject to all 3 of those dangers. Now, what I love doing is helping you eliminate those dangers. I've done it for thousands of Americans. You eliminate them, you make yourself immune, okay? And so at retirement planning is something totally different than what you did for retirement planning. And I'll show you the strategies you need to seize, but the opportunities that you need to seize is let's convert at least 40 to 60% of your retirement income to tax-free, okay? Now, I'll show you why it's tax-free, but if you have tax-free vehicles, then you're immune from taxes going up. It doesn't matter what taxes go up to because yours is tax-free, and it's been a sacred tax-free cash cow in the Internal Revenue Code for more than a century, okay? Number 2, you want to link your returns to the things that inflate. I don't like inflation any more than anybody, but it doesn't hurt me, it helps me. I've always been able to earn a rate of return that outpaces inflation because I link my returns to the things that inflate. It's that simple, okay? Number 3 is to use indexing. I'm not talking about index mutual funds. An index mutual fund is a commodity. If you had money in an index mutual fund during the Great Recession, you would have lost 40% twice. My clients that used indexing, they didn't lose a dime in the Great Recession. They tripled their money. $1 million in the year 2000 grew to $3 million by 2012. Most people in the market, $1 million dropped down to 600,000 twice and barely came back to $1 million in that 12-year period. Using indexing, they tripled their money. Without that, people barely came back to break even. That's why we call it the lost decade, okay? Now, there's 3 great strengths of my favorite financial vehicle, which is a properly structured max-funded IUL. IUL is Indexed Universal Life, and you're using it for living benefits, but these are the key elements of a prudent investment. Number 1 is liquidity, the ability to access your money when you need it. Number 2 is safety, not only of the institution, but safety of principle. When I set aside money for my future serious goals, I don't want to jeopardize it. I want to protect my principal, but any year that I make money, I want that to become newly protected principal. I don't want to lose in future years money I made in previous years. You know, most financial advisors don't know how to do that. Then I want to have a predictable rate of return that historically has outpaced inflation. So a properly structured max-funded IUL will earn 7 to 10%. If all you ever do is just do a simple portfolio at the beginning. But if you don't have annual reviews based on what's going on in America and just make tweaks, okay, that's all you'll earn is 7 to 10%. If you rebalance and diversify every year, just once a year, you can move your returns to 11 to 14% tax-free. And if you earn 11, you'll net 10 after all costs, after all fees, okay? And so those are the 3 key elements that we use with max funded IUL. So let's do a deeper dive into this episode, which is talking about how to free yourself from the IRA 401k tax trap. The first danger is taxes, and they affect everybody. And actually, inflation is sort of like a hidden tax. But see, too many American taxpayers are like this ostrich with its head in the sand and it's open season with who? The IRS. Okay. And so when the government is hard up for tax revenue, where do they go to get that money? Now, this is really simple. They go to the people who have the money, okay? It's like the old question asked of bank robbers, why do you rob banks? And they go, duh, because that's where the money is. So when they go and they tax people, who do they tax when they need money? The people who have the money, okay? The people who saved. Why are you doing that? You're penalizing the people that are trying to be independent, and you're trying to make them dependent. Hello, we declared independence in this country. And so when I ask people when they come in for their first appointment at retirement or 5 years before retirement, please bring your after-tax IRA 401k statements with you. Now, I know they don't have those, but I'm making them think that they usually go, after-tax statements? Yeah. Well, if you don't have those, I'll calculate them for you. And they come in with their before-tax statements. They have $1 million in their IRA or 401k. And then I have to be the bearer of bad news. Only about 650,000 of that is yours. The other 350,000 belongs to the government, okay? If you think that $1 million nest egg can generate 75,000 a year of income, that 75,000 each year in income is not all your money. Only about 50,000 of that is yours. The other third belongs to the federal government and the state. 41 out of 50 states has a state income tax. They're shocked. It looks like this. See, before tax, they think it looks like this sumptuous Subway hoagie sandwich, but after tax, this is what it looks like after Uncle Sam has taken a few big bites out of it, okay? And that's why I always ask people, were you planning your retirement or Uncle Sam's, okay? Now, I've taught advanced continuing education to CPAs and tax attorneys for over 5 decades. And it's interesting how many of them just go, oh my heavens, oh, these are tax-free. They're better than IRAs or 401ks. Well, I'll have egg on my face if I go back to my clients and say, well, that wasn't the best. And I go, well, it wasn't the best, but you did what you thought was the best at the time, but it was only good. But see, if you don't tell them, somebody else will. It's like one of my good, actually friends and also a motivational speaker years ago, Zig Ziglar. He used to give counsel to married couples, and he'd always get these questions from men or women in the room, and they'd say, well, when should you tell your spouse you love them? And he would roll his eyes and go, the obvious answer is before somebody else does. Yeah. If you are a CPA or tax attorney and you're afraid to tell people that there's something better than the IRAs and 401ks you've been telling them to put money into, I would recommend that you tell them before somebody else does. Tell them you found something now that's better and do a strategic rollout out of those, which is a concept that I'll give you a little glimpse of here. And so sometimes these CPAs go, well, what the public doesn't know won't hurt them. Yes, it will. And it happens all the time. Now, I have a framed copy of this Time magazine article that came out front page in 2009, right after the 2008 mortgage meltdown, where most Americans lost 40% on the value of their IRAs or 401ks for the second time in a decade. We call that the Great Recession. And Stephen Gandel was the author of this article. And he said in the article that the 401k is a lousy idea, a financial flop, a rotten repository for our retirement reserves. Now, I never use that strong of language, but I agree. And it's because most Americans got duped into 401ks and they didn't know what they were doing with money, and they lost 40% twice. And so a 401k is what is called a defined contribution plan where you define how much you're going to contribute. Whatever return you're going to get is whatever you're going to get based on where you chose to put your money. And so many corporations decided to promote those. And instead of a defined benefit. A defined benefit is a pension. They didn't want to be on the hook anymore to provide pensions. That's why they're few and far between. Well, that's why in January of 2017, the Wall Street Journal came out with an article titled The Original Champions of the 401k Lament the Day They Ever Came Up with That Idea. Why? They never intended the 401k to become the number one go-to way to save for retirement. It's not one size fits all, okay? But that's what it became because businesses says, yeah, we want hands-off. We don't want to be responsible for providing a pension anymore. We have to manage that. We're going to have our employees define the contribution. Whatever rate of return is their problem, okay? And so that's a 401k. And Stephen Gandel was saying, well, that was a lousy idea. I agree. Now, I was actually saying it's a lousy idea because people aren't in lower tax brackets when they retire. See, that's been the premise for years. Oh, defer until you retire because you'll likely be in a lower tax bracket. That has not been true or axiomatic now for over 30 years. Most savers in America are not in a lower tax bracket when they retire, okay? And they're going down the highway, metaphorically, with one foot on the gas pedal, the other foot on the brake pedal. And they don't even know they're doing it. The foot on the gas is deferring, and IRAs and 401ks. And then the foot on the brake pedal is they're killing their tax deductions as they go. They pay off their house. They don't have that deduction anymore. They're not contributing money to IRAs or 401ks when they retire. They don't have that deduction anymore. If they're a business owner and they sold their business, they don't have those deductions anymore. The kids are gone, so you don't have those deductions anymore. If they move back in as adults, you can't deduct them. And because of irresponsible government spending and the printing of money, Congress keeps raising taxes. So most Americans agree that taxes will likely be higher in the future. So then when I ask them, why are you continuing to defer and postpone and procrastinate to some future perceived unknown advantage and withdraw your money when you're convinced taxes will be higher? That doesn't make sense. And so this is what we call stable data. I usually make sure people agree with me. If they don't, then no sense going any further with them. Would you agree that these two things are certain? Money will never be worth more than it is today because inflation is going to continue. And two, your current tax bracket will likely be the lowest bracket you will ever be in. If you agree with that, then quit deferring and procrastinating because deferred taxes mean increased taxes. Why would you do that? Why would you defer to some future big nest egg and then withdraw your money later when you're convinced taxes will be higher? It'd be better to get the taxes over and done with sooner than later and enjoy tax-free, okay? And so I'd rather have tax-free growth instead of tax-deferred. So I explained that by categorizing ways that you invest. There's 5 general ways that you can save money, but let's look at it in the context of 4 phases of retirement planning. We contribute money towards these accounts. It overlaps the accumulation because hopefully you're earning interest or dividends on that. It's growing. But then we're going to take distributions someday. We do it because we're going to take out money, okay? We withdraw money. Too many people go into withdrawal when they hit this phase because of the taxes. And then the transfer phase is most Americans, if they die, okay, they leave behind something that would have sustained them had they lived longer. And so the transfer phase is often overlooked. So let's look at 5 different savings alternatives. The first is the worst, but it's the most common way Americans save is in tax as earned investments, banks, credit unions, mutual funds. If we were running $1 million dash and our goal is to cross the finish line with $1 million net, after all fees, costs, taxes, this is like crawling because you're taking after-tax money, putting it in banks and credit unions and mutual funds, and you're getting taxed every year on the interest and dividends on any gains, and it's taxed potentially again when you transfer it to your heirs. 4 red circles, okay? The next would be like walking around that racetrack, because you take after-tax money and put it into a tax-deferred account like an annuity. An annuity is a savings account with an insurance company. It's only tax-deferred. When you start taking out income, it's now taxable, LIFO. The last money you're earning, the interest is the first money coming out, okay? And then, so you pay tax. You only get one green circle is what I'm saying. Now, if you were going to be a farmer, let's say, and you had the choice of buying your seed in the springtime, and you don't have to pay tax on the price of the seed when you buy it. You plant it, you irrigate, you cultivate, and later in the fall, you harvest your crops, and now you agree to pay tax. That's a traditional IRA or 401k. You actually get a tax break on the seed, but you agree to pay tax on the harvest. Let me show you the math behind what I've talked about so far, okay? Do you know a dollar doubling 20 times, what it'll grow to? A dollar goes to $2, $4, $8, $16, $32. It'll grow to $1,048,000. Not under taxes earned. Under taxes earned, which is the way most Americans save, in a 25% tax bracket, a dollar doubles to $2, and then you pay tax of 25 cents. You only have $1.75. $1.75 doubles to $3.50. You pay tax on that. You'll only have 72,000, not a million. You only have 7.2% of what you could have had. In a 33% bracket, you'll only have 2.7%, 27,000. That's the way most Americans save. How pathetic. Now, again, if you're a farmer, I'd rather pay the tax on the seed and enjoy the harvest without tax. So when we look at this on a traditional IRA or 401k, we get a tax break on the seed, okay? But then during the harvest, we pay tax. We get 2 green circles. That's like jogging, maybe with the wind at the back at the beginning of the race. But during retirement at the end of the race, you get clobbered. I would rather just pay tax on the seed money and enjoy the harvest without tax. And you may think I'm talking about a Roth. Well, I've never owned an IRA or 401k and never will, but I've never owned a Roth. I never will, because Roths only have 2 benefits. It accumulates your money tax-free and you can access it tax-free. But you can only put in a certain dollar amount or a certain percent of your income. If you make too much money, you can't even have a Roth. You can't touch the money till age 59 and a half for 5 years. I don't want any of those strings attached. If I die, you leave behind whatever's there. My favorite is a MFTA, Max Funded Tax Advantage Section 101A Alternative, because I can accumulate my money totally tax-free. I'm not limited on how much I can put in there. And I can put in 300 grand. I don't have to. I can put in 30 grand. I can make up the rest. If you don't use a little bit of room in a Roth, you lose it. But at the end of the day, if I die, what I leave behind in a max funded tax advantage insurance contract blossoms. If I died tomorrow in an accident, every million I might have in an MFTA 101A laser fund, okay, would probably leave behind 2 million, to double to 2 million tax free. Roths don't do that, okay? So why would I mess around with the Roth? Now people say, well, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of money that would otherwise go out the window in taxes in these other alternatives. So I want 3 green circles. It'll knock the socks. It gives me 50% up to 400% more retirement income without not outliving my money. Now, I also teach people in my books how to have 4 green circles by resurrecting deductions that maybe they were killing by paying off their real estate the wrong way. I'm not going to go into that right now because I can show you how to have 3 green circles instead of none, 1, or 2. And it blows these out of the water. Let me show you mathematically. See, a lot of times people with tax-deferred IRAs or 401ks will say, well, I have my million because it's tax-deferred. You have your $1,048,000 in your IUL. It's the same. What's the diff? Well, frankly, usually I'll have more money because I earn more than those, but let's say they do the same. You don't choose investments based upon which ones grow to the most. You choose investments based upon which ones generate the most at the time in life you're going to be using the money the most. At retirement, okay? Let's go to the back 9 of an 18-hole golf game of life, retirement, okay? Most Americans in taxes earned investments will be out of money in 1 year. People with IRAs or 401ks with $1,048,000 they have to pull out 50% more in a 33% bracket to have the same income, to buy the same gallons of gas and loaves of bread that I can buy. Because in an IUL laser fund, I only have to pull out $100,000 to net $100,000. It's tax-free. In an IRA 401k, I have to pull out $150,000. Pay tax of a third, 50 to net 100. My $1 million nest egg will be gone by age 76. The same $100,000 a year in my IUL, I did not deplete one dime. In fact, it's growing ahead of inflation. If me or my spouse lives another 20 years, which one of us likely will, for baby boomer couples, life expectancy for one of you is to age 96. I get another 20 years of $100,000 of income out of an IUL. That's $2 million, and I still have my $1 million. That's a $3 million better retirement strategy than the same amount of money in an IRA or 401k starting at the same age, 65. Would you like to have a $3 million better retirement strategy? Then I'd recommend you get the money out of that IRA 401k tax trap, okay? So 4 green circles or 3 green circles. Now, let me just sum this up by saying this. People say, well, why is it tax-free? Ever since 1986 tax reform, who was president of the United States? Ronald Reagan. His second term, he passed this tax act. And ever since then, there's only 3 types of income Americans pay income tax on. Earned income, that would be salaries and wages. Passive income would be rental income or lease income. And portfolio income, interest or dividends would be an example. Now, if you have income that is not one of those 3, there's nowhere on a 1040 tax return to put it. It's tax-free. It's not a loophole. The IRS knows when my clients have $1 million in an IUL laser fund and they're taking out $100,000 a year tax-free without depleting that $1 million. They know they're receiving it and they know it's tax-free. It's not even worth auditing because it's been a sacred tax-free cash cow in the Internal Revenue Code for over a century. So folks, if you want to learn about this, I'd recommend you study my book, The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. This is a 300-page book. It's actually 2 books in one. This side, the white side, is about 200 pages, 14 chapters with all the charts and graphs if you're a left brain learner. If you're a right brain learner, you learn more by stories. You flip it over to this one. And this is 12 chapters, about 100 pages with 62 chicken soup for the financial soul stories of how the laser fund is the dream solution, not just for retirement, but for college savings, working capital for business, emergency funds, everything, okay? So if you want to use your whole brain, read both. But if you go to Amazon, thank you. You'll be able to get it for anywhere from $20 to $60. But I'll give you a copy for free. You simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I require a little skin in the game, but I'll pay for the book, fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats for your investment. You can even register for a free educational webinar we teach every week. You can even schedule an appointment to talk to a wealth specialist using IUL, an IUL specialist that will show you how it can be structured correctly so that you can see how it works in your particular set of circumstances with no cost or obligation. And so I would recommend you do that. But my plea is you must free yourself from the IRA 401k tax trap sooner than later, no later than at retirement.